Hey folks, David Frost, my strategic forecaster here for another episode of Common Sense Market Analysis. Today is Thursday, September 6, 2018. You're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. And so we had another down day today. We satisfied the initial or the first price target we discussed, 287.51. We also have not satisfied the second price target of 286.38. And as a reminder, and we have a lot of stuff to go over tonight, but as a reminder, I want to make sure that everybody's aware that I said, because I've been getting a lot of emails about this over the last day or so, I said that if the market reached 286.38 this week, I would be a willing buyer either at or potentially even slightly above or below that area, depending on how the market was coming into that area and whether or not I can find a satisfactory entry to what I wanted at the time. But somewhere in and around that number was a willing participant on the long side of the market, but it has to happen this week. That still stands if the market comes down by chance tomorrow and satisfies 286.38, maybe even slightly below that, maybe even fills the gap that exists slightly below that. There's a gap that exists right at 285.94, so it's actually a little bit below that, but not much, maybe only about 4 S&P points below that 286.38, or 40 cents, roughly 50 cents below that, is a gap that could be filled. So it depends on how a market is approaching that price level. You make the decision in real time. Before we move on and go any farther, let me just take a pause here and say a couple of things. Number one is, I've got the comments. I appreciate the comments. This is what happens in a community. I made a couple of mentions about a certain change that I was contemplating making to these videos, and I heard it loud and clear from people that appreciate the videos that don't want change. I get it. This is what happens in a community. When people like something, they tell you. When people don't like something, they tell you. I love that. So thank you very much. As a result, please continue to be interactive within the community. Post comments under the videos. Share your thoughts. I enjoy it each and every night. In addition, hit the like button on the video and share the video with somebody you think can benefit from this information. All right, so back to the market. So the question is, are we on target for essentially the schematic that I was outlining or diagramming over the last several days? And so far, so good. My idea was that we would find some kind of a low later part of this week. Well, here we are, later part of this week. Thursday came and went. Thursday was a down day. We expected the market to be down into at least Thursday, potentially beyond. I still would like to see the market a little bit lower. I have yet to find any kind of a sufficient low, even on an intraday basis, something that tells me that we have a short-term trend change at hand. So that's really the other thing that's holding me back from saying, well, look at the daily chart. You see the closes on the daily chart. You see the volume today. The volume today was just about average, so it doesn't qualify for any kind of volume that would accompany any kind of bottoming formation. We don't have a bottoming tail. We didn't even touch the 20-period moving average that shows up on the daily chart. That comes in at 286.77, and you'll see today's low came in officially at 287 even. So we never even made it to the 20-period moving average on the daily chart. So I believe there's some work yet to be done on the downside. That's my case. Could it bleed over into next week? Of course it can. That brings me to the next thing, which is what happens if we do find low between now and let's just say Monday? For argument's sake, what are my expectations? My expectations are not necessarily 4 new highs. That's item number one. Can we make new highs? Yes, but if we did, I don't believe they would be significant by any measure, maybe just by a handful of points. And then I do believe that the market's likely to go down to sideways, likely more down than sideways, for a while, several weeks at minimum. So what does that look like in a diagram form, right? Some of us like to see pictures. We think better in pictures. So here we are, we're coming down, so we're going to find a low somewhere in here. This is my thought process. We have a rally for a few days, and whether that rally makes new highs or not, I don't know. I'm not sure. But if it does, my belief is it won't be by much. And then I think we either make a lower high or we make a higher high and then sell off from some point for a while. Several weeks, we'll leave it at that. The duration, we don't have to get into right now. And I've already got people asking me to what magnitude. We don't know that just yet. We haven't really necessarily put in a top officially yet. We don't really have a topping signal. We don't have a signal of a trend change. Doesn't mean a top can't be in, but officially, I have nothing to hang my hat on other than the recent highs. There's no textbook, quote-unquote, topping signal or signal of a trend change that we have yet. Now, what are some other scenarios to look out for? What if? What are the what ifs out there? So what if we're looking for a low somewhere in the 286 to 286.50 neighborhood? And what happens if we begin getting below that area by a significant amount? What I'll say is this. If we begin closing hourly below 286 and more than 2 hours in a row, then there's likely something else developing in the market and likely lower prices are ahead. And I would postpone the thought of a short-term rally for a few days until the market really did put in an official sign or signal of a trend change. And that's really taking the high road anyway. In order to trade these markets effectively and with prudence, what you really want to do is look for a sign or a signal of a trend change. Any trader, they may be looking for a low in this general area, 287.51 down to 286.38 in that zone. We came almost split down the middle to where those two numbers today. That was the low today, was almost 50% in between those two numbers. However, wherever the low becomes, the prudent thing to do is wait for a sign or a signal of a trend change. Now that can be found on an intraday chart, meaning a 10-minute intraday chart, which would come with a whole lot more risk than a larger time frame because that's a faster moving chart. Price can move away from those price patterns and moving averages a lot faster on a 10-minute intraday chart than they can from, for example, an hourly chart or a daily chart and beyond. So, for example, if we began to get, or if we spotted a sign or a signal of a trend change on an hourly chart, and that was beginning to hold and we got a retracement, that would be something we can trade against from even an intraday perspective and also longer, meaning even a swing trading perspective if we had a bona fide signal on hand. So that's what I would be looking for down in that neck of the woods. Did we get one today? Well, at the time, you could make a case that we had somewhat of a bottoming tail and had also filled a gap at the same time we filled this 287.51 number. So based on filling the gap, based on reaching an important number of 287.51 and seeing a tail candle put in, could we assume that at least from a temporary perspective intraday today, that the lows were in, and this was a candle from 1330, so that's 1:30 in the afternoon. Could a trader have traded that to the long side against the low of that 1:30 p.m. Eastern Standard Time candle, 287 even? And the answer is yes. The problem is, and you always have to look at both sides of the coin, both sides of the equation, assess all risks. In order to trade that concept technically and effectively against the low of 287, you would technically have to wait for an hourly close to see if that was either on or off, meaning if that tail was either going to technically hold or if it was going to be broken below. And obviously, a lot can happen within the hour. But below that, we had somewhat of a safety net, 286.38. So if I was a willing buyer at 287.51 or in and around that area, based on that tail candle from today, I would have bought a partial position, and the answer to the question is no, I did not. I am and was, or today at least, was waiting for the 286.38 or somewhere in that neighborhood. We didn't get close enough, and I didn't buy that tail candle. I was thinking that the market would get to somewhere closer to the blue dotted line. I think in today's session, that's what I was thinking at the time. You have to think about what this looked like at the time. It looked like this could have been putting in a bear flag pattern before this market took off to the upside. And what did we do? We tested the high of the former or last breakdown candle. How many times do you hear me say that? At least, at minimum of once or twice every single video. Why is that? Because so many markets, so many charts on so many different time frames test highs of breakdown candles and lows of break up candles. Check this out. Let me move the chart over, and I find this fascinating to this day. Every single day I find this fascinating. The high of this candle is 288.67. The high of this candle is 288.65, 2 pennies short, and the next candle begins down. We had also overhead resistance coming in by the hourly chart 20-period moving average. Here's an intraday 10-minute chart, and there's something minor I want to point out. It's not really minor as far as the charts are concerned, but it's something that we don't talk about every single night, but I want to talk about it here because I think it's interesting, and it becomes apparent when you see it as I'm going to show it to you. And then what I want you to do is go find more situations like this on charts so that you begin to recognize where important price levels exist on the charts. So here's what I'm talking about. I just showed you the test of the top of the breakdown candle on the hourly chart. That's the same area as here. That's an important price level to the charts. We said that that price was 288.67. Now, when we talk about price in terms of the next somewhat of a lesson that I'm going to go through, it's not going to be necessary to be exact to the penny every single time. But what we want to be is within the range of a few pennies. It's not 20 or 30 cents, but it could be 5 or 10 cents and maybe a stretch to 12 or 15. It's in a general zone. It's more of a conceptual area. And here's what I mean. So we have 288.65, 288.67 in that zone. Look how many other times on the chart you can see where that price level or very close to that price level, the chart was telling us because price stopped at that price level, the chart is telling us that that price level is important, okay? It's within pennies of that price level many, many times. And if I draw a line straight through, whoops, I didn't want to do that. I wanted the black line. If I draw a line straight through, you can see that this is around the same price level and it's within pennies. So as we're coming up and I see overhead resistance by a moving average on an hourly chart, I see an hourly chart breakdown candle. Am I saying to myself, is it more likely that the market continues breaking to the upside, or is it more likely the market runs out of gas and we do find overhead resistance as the chart would under normal market conditions? The 10-minute chart, you have a 100-period moving average sloping down into price. You saw the hourly chart, 20-period moving average. I just showed you another way that you can determine how and why, if price is important on a chart because it was important in the past. Now, we know history doesn't necessarily repeat itself identically every single time, but we know it has a tendency to rhyme. If price was important on a chart in the past, there's a high degree of likelihood we'll find importance on that chart in and around that price level again into the future. Okay, moving on to the IWM. And by the way, before what we do, am I forgiven? Okay, back to the IWM. The daily chart, you can see we have somewhat of the same situation in the IWM that we have in the spider. We don't have a good enough low. Yesterday, you could make a case there was a tail candle, but those of you that have taken the course at Lazy E-mini Trader know that I don't like the tail candles where that one showed up yesterday. You know where I prefer them on the charts. In addition, We came close to the 20-period moving average on the daily chart and never touched it, never spiked through it. Same routine today. That tells me there's a higher degree of likelihood that we have lower prices in the immediate future rather than higher prices in the immediate future. Can that be wrong? Of course it can be wrong, but that's what this chart is telling me. I don't like the fact that the spider didn't hit the 20, and I don't like the fact that the IWM didn't hit the 20. What else do we have on the table with the IWM? Again, look, these are all puzzle pieces. They all go on the table. Volatility is picking up. The market is picking up. The market seemed relatively quiet because it didn't move a whole lot this afternoon other than one buy program, which wasn't a whole lot. But at the end of the day, markets were edging down. They're edging down back into, what do we call this? Home base. We talk about it when markets get extended from home base, and then everybody looks surprised when we come back into home base. And I'm not talking about everybody here. Nobody here should be surprised when we come back into home base, to be frank with you. However, I'm just saying when we have, down 3, 4, or 5 days in a row, everybody on TV looks surprised. Oh my goodness, how did the market go down? We know this is the way the market works. The other thing we have on the table today with the IWM is the fact that on a percentage basis, the IWM was leading the market to the downside today. You can see the IWM down $1.16 or 0.68 tenths of 1%. The spider, in comparison, was down 35 tenths of 1%. So about double. The IWM was pacing the spider 2-to-1 on the downside today. I think that's important. Almost 2-to-1. Not quite, but almost. I think that's important information. I'm putting it on the table. It's a puzzle piece. We'll see if it's meaningful. Look what happens when we go to the hourly chart. Remember that flag pattern on the spider chart that I said it looked like was beginning to develop before a buy program came in and they rallied the market up higher. But look what happened. Here on the 60-minute chart of the IWM, it doesn't quite look the same as it does in the spiders. This does look more like a flag pattern on the 60-minute chart of the IWM. What this would tell us, generally speaking, is that this market is going sideways to build energy for a continuation pattern that would likely leave the market filling this gap and the hourly chart 200-period moving average down here at 168.80, give or take, in that general zone. That's a larger drop than we had today. We don't have to make it all the way down there in one shot, but I just want to point something out and make everybody aware that, keep in mind, go back in terms of the spider and think tomorrow, for example. I know some of you may be planning on participating on the long side of the market. Keep in mind, getting hourly below that blue dotted trend line on an hourly closing basis twice in a row. I would say the first hour, I may give it the first hour, but twice in a row, I would potentially pitch the trade and wait for a bottoming signal if I'm not already waiting for a bottoming signal. I may wait for a daily bottoming signal. I may wait for an hourly bottoming signal. I may get in at a specific number. I have to see what the market's doing at the time and make the decision in real time. I certainly can't tell anybody else what to do, but I can tell you what my intentions are, but I also can tell you I make the final decision in real time. Back to the daily chart of the IWM, you can also see a lot of other areas where there are fair and good enough reasons and excuses for support on this chart. You have the gap we just discussed from the hourly chart. That's right here. You can see that right here. Okay, 168.75, 168.80 in that general zone. You also have the 50-period moving average at 168.13 on the daily chart. You have a series of pivots below that. That will also provide chart support. You have the 100-period moving average sloping up. So even if we got a sell across the markets, a lot different, more broad-based than we've seen thus far, I just want to point out other areas that if in fact Some of the initial zones we've discussed don't hold where these additional support areas may be. Same thing goes with the spider. You can see also here, this is the chart's way of telling us that that price level up there is important. So that's another safety net right below the blue dotted line, happens to line up with that gap right there. So you can see where my confidence level in and around that 286 area begins to grow rather large. I would find it odd. I would also find it unusual to close the week out and to close the day out tomorrow below that level. However, if we are closing the day out below that level, then something else is developing, and I would not necessarily want to be long the market on a close below that blue dotted line tomorrow to close out the week. Moving over to the VIX, we've been looking at the VIX lately, and it's been doing what we've been discussing. So the VIX was doing this ABC pattern, this bullish pullback pattern, whatever you want to call it. You can call it a variety of different things. Doesn't really matter what we call it, but here's what's been going on. So we had this pullback, and now we have this third leg of the stool going on here, the C leg. And what we've said all along was, as long as we never got a close below the low of that green breakup candle, and there we go again, and we tested it one time, came close another time, as long as we never got a close below there, then that was good for the long side of the VIX, and that would normally mean downside activity under the equity or for the equity markets. So the picture that we've been discussing in the VIX is ringing true. And here's something that I want to make mention of, along with something we talked about recently, about a minute or so ago, about we haven't seen a broad-based decline. And so here are the transports, and most of the day the transports were up today. The daily chart we're still above the 20-period moving average. We had a very nice rally off home base, or the 20-period moving average, yesterday, and we're well above there today. Not to say we can't get back down below it, but I find it interesting that while the S&P was down about 10 points today, the NASDAQ got hit pretty hard today. We haven't got there yet. It was down about 1%. While the Dow was basically flat, up 20 points on the day, that's basically flat. And also on the transports, that's flat. And we're not seeing a broad-based decline, and that also supports the case that this is more in tune or in line with a pullback with another leg higher on the horizon. Again, we don't necessarily have to make new highs, but we're not seeing a broad-based decline, which either one of two things is going to happen. This is a pullback and there's another rally coming, or the rubber band is going to get stretched, and instead of snapping back, it's going to break, and we're going to see a broad-based decline ensue because the rubber band broke to the downside and will be getting below that blue dotted line. And that would likely mean significantly below there. So that's why I want everybody to understand where the cautious side of this is. You can see here that in the triple Qs, money is coming off the table on the risk side of the table. So the IWM, risk. Triple Qs, technology, risk. We'll see in a moment the semiconductor index got hammered really, really hard today. That's a good indicator across the technology or within the technology space. So risk, or money coming off the table within the risk asset classes. So that's important information. Again, that's not necessarily on the bullish side of the case or the bullish side of the page, but it's a puzzle piece that we must put on the table. We must always look at both sides of the equation. Where did we find support today? Interesting that we found support at what you can make a case for a former breakout area. I can certainly make a case that the market went up here, consolidated for a period of time before breaking out once again to the upside, and the market came back in to retest a former breakout area. I can absolutely make that case without a shadow of a doubt. I must also recognize, is it likely, as the market corrects a little bit, just to even work off some of a short-term overbought condition, if nothing else? Is it likely or unlikely, coming close to the 50-period moving average, is it likely or unlikely that we don't hit the 50-period moving average? I would say it's more likely we hit it than we don't, but we'll have to see. That may happen tomorrow. If we hit it tomorrow and we can get a rally for a few days, I will have been proven correct, at least on this portion of the schematic. And what we have to do is let price be the final arbiter at the end of the day. How about the broker-dealer index? Look at this breakdown. So here's a great case in point. Now, again, keep in mind, nothing works 100% of the time, but when it works, it is interesting to notice it on the charts. And here's what I'm referring to. So we have a breakup candle from the 27th. So we know that as long as we close each and every day above the low of that breakup candle, then price is still, at least from that perspective, consolidating, likely to go higher. Another continuation move, especially since we were consolidating above the 50-period moving average here on the daily chart. Now, what happened yesterday? Well, here's the low. The low is 276.58. Where did we close yesterday? 276.47. And today we have a big breakdown, down almost 2% in the broker-dealers. Now, this is important in the financial sector or across the financial sector. I think in terms of the U.S. stock market, I think the XLF is probably the better proxy in terms of a financial sector. But look here. What did we do today? We fell apart in the XLF and filled a gap. Now, is that the market trading technically, or are we going to find it breaking down farther and we're going to say, yeah, it filled a gap on the way to much lower prices? We'll see what happens in the coming session or sessions. Now, here's the XLF, and the XLF doesn't look the same as the broker-dealer index. The XLF down about 0.5% today, 13 cents. Not a big move one way or the other, but still remains above all the moving averages. And really, technically speaking, nothing wrong with this market whatsoever. So I have to say, looking and visually from this chart and this perspective, the puzzle piece that goes on the table from the perspective of the XLF is a bullish case on the bullish side of the page. There's nothing signaling any trouble ahead in the XLF. Not just yet anyway. There's no canary in the XLF coal mine right here. There's a potential canary in the IWM. There's no canary in the transports. There's no canary in the XLF. There's a potential canary in the triple Qs. So you see, we have both sides of the balance sheet on the table right now. We can make both cases, so we keep moving on and look across other markets. Here's the SOX, the Philadelphia Semiconductor Index. Now that got hit very, very hard today. That's a breakdown. We've been looking at the SMH. Both charts look the same. We've been talking about this bullish pattern. Now, here's something I want to bring up. This is really, really important to notice this. We have an up move, and we begin building a bull flag pattern. For all intents and purposes, that's what was going on. Under normal conditions, you're going to see a continuation move to the upside. That's the market's way of releasing the energy to the upside. It goes sideways each time off the clock, builds up energy, and that energy gets released. And in this case, and what I just drew on the screen, a continuation move or continuation pattern to the upside off that bull flag pattern. Now, if the pattern doesn't work out and it actually works out in the other direction, or if the pattern ends up beginning to fail and price gets completed in the other direction, the same energy gets released that would have been released in the upward direction. That same energy is now released through a trap door to the downside in the downward direction, and that's what we see happening in the SMH from that bullish flag pattern that was developing over the last several days. There's no signal of a bottom just yet. In the SMH, we had good volume today, certainly 9 million shares against an average daily volume of 5.7. That's good volume, but I would have liked to seen us really come into maybe the 50-period moving average, the 100-period moving average, a more of an important price on the SMH. And look here on the hourly chart of the SMH, you can see us below the 100 and 200 beginning to go sideways, and there's a gap right below us, right around 105.5, give or take. So I've got my eye on that target on the SMH also. Just not convinced that we're not finished with the downside across the markets. Let's see what Friday's session brings. Gold, is there anything doing worthwhile discussing of value in gold? Well, I have to say that the longer they continue to move sideways and eat time off the clock, the longer they continue to do that, the more likely they're building energy to make a push higher going into at least the 50-period moving average, or even potentially higher depending on how long we go sideways for. And you know the routine. As long as we stay above the low of 1189.50 on a daily chart closing basis, then that pattern remains intact. Close below the low of that breakup candle, and that story's off the table and lower prices are likely. That's the story. As long as we remain above the 20-period moving average, that's even more leaning on the bullish side of the table, or from the bullish case, if you will. In crude oil, you can see us came into, spiked through, but closed above the convergence of the 100-period and 20-period moving averages. So this is the candle from Thursday, September 6th. The little blurb you see on the screen is the electronic session that will lead into Friday's session. But you can see there's an important area down here. Really, the weekly close is going to be important. I was suspect of that candle the other day. I said I wasn't convinced it was a good tail candle. I would have liked to see the market test closer to 72. We missed it by a lot. So I really didn't love that setup. And so I had no dog in the fight. I had no short position, no long position, nothing on either way in crude oil. Just an umpire calling balls and strikes. So right here, I have to see the close tomorrow. If we get below these moving averages, and if we get below them intraday and we begin closing below those price levels on an hourly intraday basis, that's going to be negative for crude, and they're going to want to make their way down and test the low of $65.98. Just call it $66. If they stay above the 120-period moving average, they'll want to work their way back up to 68.5. That's the way I see the chart in crude oil. And with that, folks, I'm out of gas myself. We're going to give it a wrap here tonight. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.